Hello, everyone. Andrew asked this, I think, very good question regarding what might my sell box criteria, sell box, not buy box, sell box criteria be for a single family 1 to 4 door, that being a single family, a duplex, triplex, or a quadplex that I own as an investment, a direct investment. What would be my sell box criteria on any particular property? That's a great question because I've had to look at this over 4 decades of owning just that kind of property, and when to dispose of a property makes a lot of sense. So I made some notes here. Let me just give this to you. First and foremost would be age and condition of that property. Most of the properties I bought over my time were properties that were 20, 30 years, sometimes older than that. So they were older properties that definitely needed more CapEx, capital expenditures to repair, fix up, maintain, repairs, but still in good neighborhoods. But that plays into it. How much ongoing repair and capital expenditure, for replacing stuff that just this wears out on properties, right? The history to date. What's the history to date of that property in the last at least 2 or 3 years? If you've had a property that long, hopefully you can look back. Well, what's been the history in terms of a tenant turnover? If it's in a good area and a good floor plan, it attracts good tenants, good schools, good access to jobs, then that's good. You keep tenants longer term, then that's a big positive. If you have a lot of turnover for whatever reason, that's not good. And you have to really look at how that affects your overall return on investment, your costs of turnover. The area demographics. Is the area stable? Is it trending up because there's kind of gentrification going on there, or it's just a place where people are moving to? Or is it going down? If the area is declining, for sure, I'm probably thinking about moving that equity somewhere else, putting my investment capital somewhere else. If it's stable or going up, that could be a positive, right? The current net operating income, net. That means after all expenses, right, including management fees, including repairs, including property taxes, insurance, which have all gone up. What's that net? Divide that by your total investment in that property, your total investment, including everything you put in for down payment, if you financed it, all your closing costs, anything else you put in the property as a capital expenditure to improve the property. Divide that into the NOI and get your cap rate. If your cap rate's not at least 5.5%, then I don't think I'd be keeping that property. And that's probably was easy to do prior to 2020 and 2021. If you bought a property, say 2022 to recent, tougher to hit a cap rate of 5.5. Most are around 3.5, maybe 4. Well, if you're financing at 7, you're upside down cap rate to your interest rate. That really makes no sense at all. So if you got that kind of property and you could sell it and get out, I'd get out. The hassle factor. Yeah, back to turnover, repairs, management. What's the hassle factor? Is it eat a lot of your time up? Is this like, if it's just wearing you down? That got to me after a while of owning a lot of properties over the years. They were good. A good portfolio really is what gave me my freedom over the years. But I put a lot of time into it. Even though I had managers in place, it's still, you've got to be on it kind of all the time. That's good when you're younger. But eventually you want to see the fruits of that labor, those investments pay off, and there's a time to sell. What do you think the further appreciation factor might be? The inflation hedge, which is one of the big reasons we buy real estate, right? Well, I think we're kind of at the top of the market. I'm not saying that housing in single family or 1 to 4 doors is going to decline precipitously, particularly in the markets we invest in. Probably stay relatively stable, maybe a little drop. But what's the potential for a big run up again? I don't see it. So if everything else is marginal and I don't see a big inflation push on price points, again, would make me think maybe I don't keep this investment, again, if these other factors are not redeeming factors in a positive way. And the last one would be, what do I see for the economy going forward? Well, I see a correction in the stock market. So a reversal of the wealth effect that we've seen so much in the last number of years. Reversal of wealth effect means everything starts to kind of deflate. All assets that have gone up deflate to some extent. Consumers, our tenants, many of them are living paycheck to paycheck already, and that means that doesn't mean good properties won't still always attract somebody who can pay, or people double up, but it's going to get a little dicier out there. So again, there's reasons to keep good properties, and I'm not saying sell your whole portfolio. If you've got newer properties that are cash flowing well, and the hassle and the maintenance factor, repair factors down, and the tenant turnover is down, I'd probably hang on. But if those other factors aren't really super positives, and you could sell the property and get out and move that equity somewhere else, probably a good time. I'm always bullish on the long term in real estate, but there's times to be very specific about why you're holding particular equities anywhere, whether it's a direct investment or in an equity syndication, a multifamily or self-storage, or even in a fund that has more equity, growth or hybrid income and growth. Where's the growth coming from today? Where's that going to come from? If it's not there, then I'm pulling back a little bit and saying I want my capital in more of a contractual debt type of return than the equities. We've talked about that, but hope that helps you, Andrew, and helps anybody else who's got some properties that you're thinking about. What do I do with these?